Welcome to the show. Be the boss of your money. I'm Mitch Goldberg, your host, and we're going to get into a couple of things about the market. Remember, this is not just another news show or a market commentary show. It's a show about perspective. We do look at news, but we add perspective. We want to go over what's important, what's not, what's noise. And about 99.9% of the news you hear is actually noise and has nothing to do with you actually accumulating wealth and reaching your financial goals. So, without further ado, if you have any questions about what we're talking about, please ask me in the questions. I love hearing from you. And if you don't mind, give us a thumbs up or whatever reaction is available to you on depending on which social media platform you're watching on. And if you're watching from YouTube, certainly please subscribe to my channel. I post a lot of content. I'm also on Instagram at InstaMitchG, Facebook Client First Strategy, and LinkedIn Mitchell Goldberg. So follow me, connect with me in any of those places. Let's roll the intro, and we're going to just have a nice quick show because yours truly has to get out of here soon for a quick happy hour with my networking group that started about 3 minutes ago. All right. So let's take a look at a couple of quick details. Okay. The Dow is up a measly 10 points, but at least it was up. NASDAQ was down 81 points, but only about a 0.5%. It's actually, in my book, that's a bit of an improvement over the last couple of days. The NASDAQ's down about 5 days in a row, and it's given back about almost 5% of its gains from its recent high last week. That's not all this week. It's been coming down since the middle of last week. And that's not, I think that's to be expected. It's not surprising. The NASDAQ was up over 40% last year, biggest gain since the year 2000. Keep in mind, folks, we had a pretty dismal year in 2022. So a lot of what you saw in last year's returns were a lot of catch up or bounce, and for good reason. But the S&P 500 off 0.3%, not that big of a deal. It's off about 1/3%. Oil was off. I know what everybody's thinking. People walking around with this assumption that oil is about to skyrocket and plunder the economy into a recession. Please keep in mind that we have vast oil production in the United States. We don't rely in any way, shape, or form on Middle Eastern oil. And we have a massive surplus of gasoline. So it's hard to envision the price of oil going up and sticking up. As far as strife goes in the Middle East, there's talk that, or worries that, the strife could go into a broader geopolitical arena from just Israel, Hamas to Iran, Saudi Arabia, the United States. But I've been saying this whole time, I'm going to continue repeating. I'm now a geopolitical expert. I don't think it happens. I don't think anybody wants to go into an all-out war with anybody else over what's happening with the Palestinians. People could hoot and holler. They could make statements at the United Nations. But so far, nothing has happened. And I expect it to stay that way. Iran is walking a fine line by backing the Houthis, and they're attacking naval assets, including U.S. So they are walking a fine line, and we'll see what happens. But right now, cooler heads are prevailing. Saudi Arabia and Iran, I don't think, want to be in a direct confrontation. They both have a lot to lose. And if Saudi Arabia fights Iran, the United States backs Saudi Arabia, everyone has so much to lose and virtually nothing to gain. So I don't really see oil doing, I don't see it rocketing higher anytime soon. The big news, there's a few news events today. It is a pretty quiet day. Tomorrow we get the non-farm payroll figures, but right now the 10-year Treasury reached 4%. As you can see right here, it's a little over 4%. That's newsworthy. We're trying to decide, is that the new line in the sand where every time the 10-year treasury goes above 4%, stocks go down. When it goes below 4%, stocks go up. We had that trade back and forth with the 2-year yield at 5%. But now we're looking at the 10-year yield. So we shall see. But right now, the markets are very more like meandering. Now, granted, the largest of large cap tech stocks are giving back some of their massive gains, which I think is not a surprise. But other than that, the S&P and the Dow are kind of meandering around, not really doing much, and investors are looking for direction. First piece of direction is tomorrow with the Department of Labor non-farm payrolls. We'll figure out what the new unemployment rate is. It's for the December period, by the way. And we'll see what wages did. We'll see if the Fed considers that for anything. We are hoping or expecting the Fed to start cutting rates pretty soon next year, but Fed officials are trying to push back on that, and they're saying we might not see any rate decreases, any rate cuts. And if we do, we might not see them until the second half of next year. So that's putting a little cold water on the market. The market will figure this out, and whether if it happens early next year, mid next year, late next year, as long as we think it's happening, everything will be okay. The VIX was barely up, nothing to shout about. A couple of big movers that I think are worth noting. I hate looking at the blink screen, so maybe, okay, so let's take a look at Walgreens. Walgreens hit, did they hit a 52-week low? No, they didn't hit a 52-week low. But Walgreens used to be a stock that clients love to buy. I was never a big fan of it. I actually never heard of Walgreens until I was probably in my mid-20s when a client from another state said, I want to buy Walgreens. They always do a 2-for-3 split. They always raise the dividend. And then a couple of years ago, they started popping up all over Long Island. But when I was a kid, I never heard of Walgreens. So anyway, it's a Dow stock. I don't really see why this is a Dow stock anymore. The Dow Jones wants stocks at a higher price, not lower price. The company, ever since they did that acquisition with Boots Alliance, a British pharmacy company, has never amounted to anything. And if there's going to be any changes coming up to the Dow Jones Industrial Average, this will be it, because now the stock is so low that when it moves, it has almost no impact on the index that it's in, the Dow Jones. It's in the S&P also, but it's not doing anything for the Dow. All right, so the Dow is a price-weighted index, so the Dow is, people who manage the Dow index care more about stock price, while people who manage the S&P 500 index care more about total valuation of the company, which is the stock price times the shares outstanding. But for the Dow, it's just the stock price. It has nothing to do with the shares outstanding. Okay, so they cut the dividend in half. And this is just another company in a long line of old, staid, blue chip companies that eventually get around to cutting their dividends, which is why I always say buying a stock for the dividend is the wrong move. It's a positive. It's one of the many things that I would consider when looking at a stock, but the dividend alone should not be enough to drive your investment decision, in my opinion. Let's see if Mobileye, if we could get that one, maybe if I refresh the screen. Okay, there we go. Mobileye, 52-week low. Semiconductor company for self-driving cars, down almost 25% year low. This has also brought down other semiconductor stocks that are in the automobile space. And it's not that there's anything wrong with the technology. It's just that all of a sudden people woke up and realized that there's a glut of their products on the market. And we're starting to hear that phrase lately a lot. There's a glut of gasoline. There's starting to become a glut of certain kinds of semiconductor chips. There was a glut of sneakers. We noticed that through Nike. We're starting to see gluts when we used to have problems getting goods. So that's cleared up. We'll see what the changes to shipping routes bypassing the Red Sea look like. But right now we're starting to see gluts of products, and that is just indicative of the Fed trying to slow the economy, and it's working. And JP Morgan hit a 52-week high. Stock went out at 171. Hit a new high of 173. JP Morgan has been an absolute beast in the last year. Let's see if we could pull up a chart. Look at that chart. That is just a beast of a chart from down here to up here. This is this past late October when people were selling stocks like crazy, and we talked about in the show, don't be selling your best companies. Okay, let's just keep cool, keep calm. Anyway, that's what's going on in the market. It's not been an overly eventful day. I think the market hangover continues with the biggest winners of last year, and until we see the selling dry up, which will be impacted by labor figures tomorrow and earnings starting next week, I don't really expect anything much to change. But, you never know. And this is why we always say invest according to you, your needs, your risk tolerance, and don't worry about all the other stuff, the noise that's going on. Have a great day, and I'll be back tomorrow. Thank you.